the United States is preparing to impose a 100% tariff on imports, but the real question is, what's driving this drastic measure? China is making strategic financial moves, cutting its holdings of U.S. Treasury bonds while aggressively increasing its gold reserves. These moves could send shockwaves through the global economy, altering the financial system in ways that could challenge American dominance. In early 2025, President Trump made a strong statement. If BRICS nations continue to bypass the US dollar in international transactions, they will face a steep 100% tariff. This is a direct warning to China, which has been working for years to reduce its reliance on the dollar. For decades, the US dollar has been the dominant global reserve currency, allowing America to borrow easily and maintain control over international trade. However, BRICS nations, led by China, are actively taking steps to change this dynamic. Trump has made it clear that if BRICS nations refuse to keep using the dollar, it won't just mean financial losses for the US, it could also lead to the dollar losing its global dominance. If that happens, the impact on the American economy would be massive, weakening its financial power worldwide. In response to rising economic tensions, China is shifting its financial strategy. Instead of continuing to invest in US Treasury bonds, Beijing has drastically reduced its holdings. At the same time, it is rapidly building up its gold reserves, adding 250 tons in 2024 alone. This isn't just about diversifying assets. It's a calculated move to reduce dependence on the dollar and protect China's economy from financial instability. For years, China was one of the biggest foreign buyers of US debt, helping to finance America's national spending. Now, it is moving away from that position, preparing for a future in which the dollar may not dominate global markets. By stockpiling gold, China is creating a safety net against economic uncertainty and potential US sanctions. This isn't just a short-term reaction. It's a long-term strategy aimed at strengthening China's financial security. If gold starts replacing the dollar in global trade, the consequences could be enormous. The US has benefited for decades from the dollar's status as the world's reserve currency, which has given it enormous financial influence. However, if countries shift toward gold-backed transactions, the dollar's power could decline, leaving the US with fewer options to control global finance. Without the dollar as the world's primary trade currency, the US could face rising borrowing costs and a loss of economic control. This would make it harder to fund government spending and maintain economic stability. The financial world would need to adapt, and gold could return to a central role in international transactions. China isn't acting alone. Other BRICS nations, including Russia, India, and Brazil, are also increasing their gold reserves and exploring alternatives to the US dollar. This trend is spreading beyond BRICS, with countries like Japan also reducing their US Treasury holdings. Even longtime American financial partners are starting to hedge their bets, raising concerns about the future of the dollar's dominance. China and Japan, once the largest holders of US debt, are now reducing their exposure. This raises major questions about the stability of the American economy. If major global creditors no longer trust US Treasury bonds, financial markets could see a significant shift. Investors are watching these developments closely. If US debt continues to rise while interest rates surge, where will global capital move? Is the dollar still the safest investment? How will major financial institutions respond if confidence in US bonds declines? The global financial system may be shifting faster than expected, and these changes could have long-term effects. If these trends continue, the US may no longer be able to rely on the dollar's supremacy to maintain its economic influence. The coming years will determine whether this is a temporary adjustment or a permanent financial realignment. Financial storm that is shaking the foundations of the global economy. Japan, once one of the largest investors in US government bonds, has made a dramatic shift. In October 2024, Japan sold over $20 billion in US Treasuries, raising concerns about the future of American financial stability. The primary driver behind this move was the sharp decline of the Japanese yen, which fell to its weakest level in decades. To stabilize its currency, the Japanese government intervened by selling off US Treasuries and using those funds to purchase yen, preventing further devaluation. Beyond currency concerns, Japan is also focusing on strengthening its domestic economy. Instead of holding large amounts of US debt, it is prioritizing investments in infrastructure, technology, and key industries that will ensure long-term economic independence. This shift is not just a short-term adjustment. It is a strategic decision to reduce reliance on foreign debt and build a more self-sufficient financial system. China is following a similar path. At its peak in 2014, China held $1.27 trillion in U.S. Treasuries, but by the end of 2024, its holdings had dropped below $800 billion, the lowest level in over a decade. This significant decline comes amid ongoing trade tensions between the U.S. and China. Instead of investing heavily in U.S. debt, China has been diversifying its foreign reserves, increasing its gold holdings, and shifting investments into other global markets. Beijing no longer wants to rely on the U.S. dollar as the backbone of its economy, and this move could accelerate a major transformation in the global financial system. The sell-off of U.S. Treasuries by Japan and China could trigger serious consequences for the American economy. If these major financial players stop buying U.S. bonds, the American government may be forced to raise interest rates to attract other investors. Higher interest rates mean increased borrowing costs, not just for the government but also for businesses and everyday Americans. With the national debt exceeding $34 trillion, even a small rise in interest rates could make it more expensive for the U.S. to service its debt, leaving less funding for critical sectors like healthcare, education, and infrastructure. If this trend continues, the U.S. will face a serious challenge in maintaining financial stability. The key question now is whether Washington will act to counter these developments, or if the American economy will be forced to adjust to a new financial reality. The situation could become even more unpredictable if Donald Trump returns to the White House. During his previous term, Trump repeatedly criticized countries like Japan and China for what he saw as unfair trade practices. He also implemented protectionist policies to safeguard American industries. If he regains power, he may attempt to pressure Japan into continuing its investment in U.S. Treasuries. However, it's uncertain whether Japan would comply. If the U.S. maintains a protectionist stance, Japan may accelerate its economic pivot toward China, the European Union, and other Asian nations, further reducing its reliance on American financial systems. The real question is whether the U.S. can find new buyers for its debt if Japan and China continue reducing their holdings. If other nations follow their lead, Washington could face an unprecedented challenge in maintaining its financial dominance. The global financial system appears to be shifting, and the U.S. may need to act quickly to adapt or risk losing its position as the world's primary economic power. Meanwhile, financial markets are already feeling the strain. The effects of these economic shifts are evident, with investors increasingly worried about the stability of the U.S. economy. In just a single day, $4 trillion was wiped from the U.S. stock market, sending shockwaves through industries and rattling investor confidence. The trade war has done more than disrupt manufacturing. It has triggered a financial crisis that is reshaping the global economy, reducing U.S. reliance on foreign energy. This move sent shockwaves through both economies, intensifying tensions and creating immediate financial consequences.